everybody, this is Toni Turner and welcome to the market now as of Friday, March 24th at about 1:30 p.m. Eastern. Well, so far today, Wall Street's main indexes are wandering higher and lower. A little bit of negativity here with investors fleeing from risky assets on growing concerns that a contagion in the banking sector has not been fully averted despite assurances from key officials. Deutsche Bank's credit default swap shot to a 4-year high, driving strong selling interest. Deutsche Bank is down more than 10%, hitting its lowest level since early October. And on that slightly less than cheerful note, let's see if we can find some cheer in the markets by looking at the next three charts. Our first chart today, as always, is a daily chart of the S&P 500 SPDR, symbol SPY. Of course, this is the exchange-traded fund that closely follows our benchmark S&P 500 index. Why do we care where the S&P 500 index even goes? We care because it is a leader. It is a compilation of the top 500 stocks by market capitalization in the stock market, and we follow it because stocks will tend to follow this particular index, of course, depending on what kind of sector they're in and so forth. So today, when I captured this chart, the SPY was trading at $393.17. It's still trading at, last week we talked about it trading above the SPY's October lows back here. The October lows came in at 348, and to remain or be in a technically a bull market, whatever asset you're looking at needs to trade at least 20% above those recent lows. We're not doing 20% yet here. We're doing 11%, but it's better than some earlier lows. So at any rate, we know from those October lows that the SPY ran up to these November and December highs at 410, then fell quickly down into the end of the year through December. Then the SPY started climbing in January, moved up again over the red line, the 20-day moving average, the green line, the simple 50-day moving average, even managed to bounce up above the 200-day moving average, which was coming down overhead. That can be a pretty tough ceiling when it wants to be. But the SPY finally climbed above it all to go up to reach a high of 418 on February 2nd. That was a high for a lot of asset classes that date of February 2nd. Then it consolidated a little bit, started sliding south. We talked about an overbought RSI here, meaning too many buyers, you could say, and just as we kind of thought might happen, the SPY started falling a little bit, not too bad, kind of consolidating, but then in February heading down lower again, below the 20-day, below the 50-day, rallied up, tried to get better in the end of February, couldn't do it, and fell hard into March down to this low at about 380. Now this low lines up with the 375 low that was created by this consolidation in December, so it's good that buyers that came in here, also the buyers came in here to hold the SPY up when it came down to revisit that 375, 380 zone. So buyers held it up here in March a couple of weeks ago. That's a good thing, we can say, if we need some good news here. And then the SPY started up in the last couple of weeks, kind of a dubious move up, but at least it got back up above the black line, the 200-day moving average, and that is now coming in at $392.32. So just keep a note with 392 on it. And of course, as I told you a minute ago, the SPY is trading at $393.17. It's just been walking up and down that SPY, the 200-day moving average, all day long. It did try to, earlier in the week, get up over the 50-day moving average, but the SPY could not do that. It tried to move up higher, but then fell back down. So now it's basically wandering along here. You can see where I drew some short trend lines here. You can see a triangle is forming here. I drew it from the lows at 375 up to 380 to that low, and then down overhead these lower highs that have been constructed here in February and March so far. So basically, if you look back into November and December, we could draw lines, but I don't want to confuse it too much. We're basically going sideways here. What's basically happening is the SPY is trading in a range between 375 or so, up here to 415, a little lower highs at 410, but we're basically figuring out where we're going to go next here, and it's gotten quite confusing. You can see all the volume coming in. Of course, that is because there are banks. There are financial companies in the S&P 500 spider, unlike the NASDAQ, which does not have any, and that's why they're so different. So everybody's keeping an eye on the banks, and that is the reason albeit there are strong stocks in the S&P 500 that are not financial related. So it's kind of like we're bouncing along here, deciding which way we are going to go as we move out of the first quarter. So it's kind of like we're going to just keep watching here. I'm going to watch the 200-day moving average, which is, of course, we're going to call it 380. I'm watching to see next week, in the coming week, if the SPY can climb up over the 50-day moving average. That right now is coming in at $400.43. Just call it 400 to make it easy. So to be bullish, the SPY should move up and climb above that $400 mark, the 50-day moving average. It would be very nice if it could stay above the 200-day moving average, but definitely to stay bullish, it needs to stay above this 375 to 380 line. So keep an eye on the SPY and those numbers in the coming week. That's going to tell us a lot about the mood and manner of the market going forward. Our next chart today is a daily chart of the Invesco QQQ, symbol QQQ. As you all know, this ETF represents the NASDAQ 100, the top non-financial, that's important, the top non-financial companies by market capitalization in the NASDAQ stock market. We're talking the companies like Apple, Amazon, Microsoft, Alphabet, Netflix, Tesla, that whole group. Now, when I captured this chart today, the QQQ was trading at $308.66. That's about 21% above this October low back here. So the NASDAQ is officially in a bull market right now, at least by 1%. Now, these October lows came in, that gap down that we had at $254.26. Excuse me, we know that from its October lows, it rallied, then slipped lower, but made a higher low. So buyers came in more quickly. It didn't have to go all the way down to that 254 lows. So it came up, then rallied above the 20-day moving average, the 50-day, made a nice move here. But when you see a gap up like this and then a fall on the day down and closing near the lows, it is a negative sign. There's no two ways about it. And sometimes it plays out, and this time it played out pretty dramatically. The QQQ slipped down in the end of the year down to its October, I'm sorry, I'm looking for these numbers here, down to 259, 260. That's where I wanted to say. Then in January, the QQQ climbed. Like everybody was saying, tech stocks are going to get left behind. No, we don't care about interest rates. It's going to go up and up and up. Well, that was a nice rally, but it was almost too steep to stay. And it moved up dramatically to the February 2nd highs at 313.68. Then we talked about it being overbought on the 14-day RSI, and sure enough, it slid back down to its 200-day moving average, made a nice little, almost we can call it a little double bottom move here, but certainly before it broke too much lower down here around 285. It held on, and in the last 2 weeks, like the SPY, it's been moving, but the SPY has been kind of moaning and groaning. The QQQ is definitely, the tech stocks are definitely moving up a little higher here, even though higher interest rates are very hard on tech companies. So now it's moved back up to, and when I captured this chart today, it's moved up to $308.66. It's above, nicely above, its 200-day, its 50-day, and 20-day moving average. So now what do we do? And should we buy tech stocks here, or should we wait to see what's going to happen next? It's definitely, this pattern of the Qs is definitely stronger than the SPY, and that again is because of the financials that are in the S&P 500 that are not in the NASDAQ 100. So, but can this rally last? Because again, high interest rates are hard on tech stocks. So it's definitely stronger than the SPY at the moment, but we got to keep an eye on it. So now the QQQ is coming into that prior February high resistance of 313.68. The Qs are coming into that resistance now, and again trading at about $308 right now, and you can see it faltering so far. Now, are the Qs in the coming week going to be able to move up and above that 300, call it 314 resistance line here, or is that going to be too tough to do? We don't know. You know, there's a lot going on. We also want to keep an eye on if the Qs can't do it and they have to return, we want them to definitely, we want it to definitely stay above the 285 to 290 line in order to remain bullish. So as I usually say when things are getting a little crazy in the market, remember that cash is a position and a very dignified one. So please just be careful in this kind of market environment, because every day can bring something we totally didn't expect. Of course, that happens all the time anyway, doesn't it? Okay, our last chart today is the Consumer Staples Select Sector Spider Fund, the XLP. I did go through a lot of ETFs today, industry groups. I didn't find many setups at all that I really liked to get into until I see what happens in the coming week. But I did look here at the daily chart of the Consumer Staples ETF, the XLP. And you know, this is a defensive play, definitely is. You know, don't want to hide it. It is a defensive play. We don't know quite what is going on in the market, if the techs can keep going or not. So I'm looking at this. The top holdings of the XLP include Procter & Gamble, PepsiCo, Coca-Cola, Costco, and Walmart. Now, when I captured this chart today, the XLP was trading at $72.74. It made a recent low. We're always looking at these October lows. It made a recent low, relatively recent low in October at $66.17. And then the Consumer Staples ETF made a very impressive move up here. Now, again, it's an almost too good to be true. I mean, it's good and it's wonderful if you're in it, and as it keeps going, but look at the angle of this, trend. It's too, I mean, ride it while you can, but know that it's very, very, when you get a really steep move up like here, even in, of all things, Consumer Staples, it's not going to last forever, so you want to be mindful of that. It came up to a very impressive high in December at $77.62, and then it had that gap up, fall down, much lower candle, which is always, especially gapping into prior resistance. You want to always keep an eye on that. It is a heads up that you need to take a close look if you're trading to what happens next. And sure enough, the XLP fell into the end of the year, and it was overbought on the RSI. You can see it right here. So if you're a trader and you know to look for that, you say, yeah, I'm not going to buy here. That's buying high. I'll wait a little bit. So it came down into December. then I should say, then it fell into the end of the year. Then in January, it fell to 71.60 on January 20th, right here. So it bumped up, and then it started moving sideways here, but it made it a little triangle here. This line is going down, and then it broke down in February, broke down to a lower level here below 71, and actually fell to $70.84 on March 10th. But since then it has started rallying up a little bit here, and now it's hitting its head on the 200-day moving average and the 50-day moving average, which are coming down overhead. And you say, well, Toni, with all that resistance, why in the world are you watching the XLP? Well, I'm watching it because look down. Look at the volume spikes here. Now, the volume is coming into it. You always look at immediate volume, and certainly there's a gathering of volume here. If the XLP were going lower on strong volume, I'd say keep your fingers off of it. But since it's really getting higher, the volume here is really gathering a little speed, and price is consolidating, it's not heading any lower, I'm saying to myself, I wonder if in the coming week the XLP can move up over the 50 and the 200-day moving averages, meaning can it break out over this line? So, in the coming week, if the S&P 500 if the SPY can behave fairly well, not fall like a stone, if it can behave fairly well, and the XLP can climb above its 50 and 200-day moving averages, and just say that, to make life easy, say that these moving averages are coming in here at say 72, just to round them off and make it easy for you to make a note. So if they can, I'm sorry, I mean 73. So if the XLP in the coming week can climb above its 200-day moving averages to 73, and if they can stay there, or if it, I should say, can stay there for a couple of days, I may add a small position of the XLP to my trading portfolio. Now my stop is going to be down here below this low. It's going to be at $70.70, right down here. Then, once I'm in, if and when the XLP can climb over $74 and I've got $74.50. That's not a straight line. And stays there for 3 closes. Again, I will add more shares to my position, and of course by then I'll have a trailing stop. So you may want to keep an eye on the XLP in the coming week. And now, while the market is making up its mind which way to go next, if you'd like to become a more successful trader, this is the perfect time to check out my trader training programs. You can choose from 10 different online training programs, like our popular flagship product, 7 Steps to Successful Trading. Plus, you'll find easy to learn strategies in how to swing trade successfully, how to become a trend trader and trade the trend to profits. That's one of my favorites. How to read charts. 3 winning setups is great for short-term traders. And of course, learning how to bottom fish like a pro is very much needed in this particular environment. So find out how to elevate your trading skill set and increase your gains quickly and easily. To see all of my online training programs, you can simply go to the link on this screen, or easier still, just click on the orange button below. Until next week, be careful out there. Keep green on your screen. I'm Toni Turner, and this is The Market Now.